Today's Saturday, June 21st, 2025, and this week has had a lot to go over. Many of this has had major implications for the stock market, not only now, but for the very near future. I'm going to give you not only news and highlights from the week, but also I'm going to give you a bonus this week because I dug deeper and found a couple of specific stocks to keep an eye on, specifically stemming from the possible war that's happening right now. If global conflict escalates, such as a broader war involving the Middle East or other geopolitical flashpoints, the stock market typically sees sectoral shifts rather than broad rallies. Investors often rotate into defense, energy, and cybersecurity. There's three specific stocks that I'm looking at closely, but first I have a couple of honorable mentions that I want to show you. First would be NOC, Northrop Grumman, which has stealth tech and missile defense systems. That one's pretty self-explanatory for this period. Next would be Raytheon RTX. This is a maker of Patriot missiles, radar, and hypersonic systems. Again, another thing very important during war times. Next would be Occidental Petroleum, OXY. This one has a high leverage to oil, and it's backed by Warren Buffett. During war times, oil is very important. And then lastly would be CrowdStrike, CRWD. This is a cyber defense play. War increases the risk of state-backed cyber attacks. So like I said before, during war times we see more of a sectoral shift rather than an incredible just broad rally of the entire stock market. And so looking at specific sectors is going to be very important, but even more important are these three stocks within those sectors. First one is Lockheed Martin, LMT. The sector here is aerospace and defense, and why it's strong in war scenarios is it's a major US military contractor behind the F-35, missile systems, and satellites. It gets consistent contracts from the Pentagons and allies like NATO. It has a high dividend yield, and that adds income stability during volatile times. The key metrics for this company and this stock is the forward PE ratio, which is around 17, which is pretty solid and in value territory. It has strong cash flow and backlog exceeding $150 billion. As of today, it's $468.60, and it's down negative 2.83% year to date, so it's on sale. Next stock that I'm looking at and that you should definitely have on your radar is ExxonMobil. Obviously, the sector here is energy because it's oil and gas. Why this one's strong in war scenarios is that war often spikes oil prices, as seen in 2022 and June 2025, boosting profits. Vertical integration gives it exposure across exploration, refining, and chemicals. It has a solid dividend around 3.5% with strong history of payout increases. The key metrics here are that it has a cash-rich balance sheet of about $30 billion and investing in LNG and low carbon as future hedge. XOM is at $113.19 and it's up 5.48% year to date. This last one on the list is one that I've been heavily investing into, and this is Palantir Technologies, PLTR. The sector is defense tech / cybersecurity, and this one provides battlefield intelligence, AI surveillance, and decision platforms for US defense and NATO. It was widely used in the Ukraine war for targeting and logistics. It's also expanding into commercial AI and analytics. The key metrics here and why I really like this one is the revenue growth, about 20% growth year over year. It has immense contracts with the US Army, Air Force, UK MOD. Palantir is at $139.96 and it's up 86.14% year to date. The obvious con on this one is that PE ratio that's up over 600, which is absolutely insane. But I am a long-term investor in Palantir, and I've been investing in it heavy since last year and still have been investing in it this year, especially through the dips. I believe this company has a lot of room to grow. It has a market cap of $330 billion, which is big, but that is still much smaller than companies like Netflix or Tesla, and 10 times smaller than that of Nvidia. Palantir will be the leader in this space, so I expect the growth to follow. I also researched what's happened in the past couple of wars as far as the overall stock market, just so you can have an idea of what might happen and also what we're probably going to see in these next couple of months. In the Gulf War, 1990 to 1991, there was some pre-war panic and it went down about 17%. But then within the next 6 to 12 months, as far as a trend, it was up 17%. The key sectors that benefited during that time was energy and defense. In 1999, the Kosovo War. At first, there was flat to modest gain, nothing really happened there, but during the war, the stock market went up 7.6%, and the key sectors that benefited were tech and defense. In 2003, the Iraq War, there was a mild pre-war drop, but then during that time period, it went up about 35% in a year. The key sectors that benefited were energy, aerospace, and industrials. Now, obviously, for that Iraq war, it did carry on for quite some time. We had troops there forever, it seemed like, from 2003 to about 2010. And so the stock market didn't do great that whole period. There was actually a couple of years there, like 2008, that it absolutely dropped huge, but it wasn't because of the war only. There was also the financial crisis, the housing issues. And so it's tough to say during that time, but as far as specifically at the war time, which is what we care about right now, the stock market did go up 35% within about 12 months. The big thing that I want you to just look at though is those sectors that were affected. The key sectors that benefited throughout those three were energy, defense, tech, aerospace, and industrials. So let's just talk about the general patterns of what happens when a war happens, especially as it relates to the stock market. And then I'll talk about what happened over this last week. The big thing is that uncertainty hurts. The markets typically fall before the war on fear of the unknown. And that's what we're seeing right now. And that's what I think we'll see even more depending on what news comes out over the next weeks. When we do have some clarity though, we do see a rebound pretty quickly. Once the conflict starts and outcomes seem clearer, markets rally. Defense, oil, and gold usually perform and outperform at that. If it's a shorter war, obviously a muted impact, but longer wars obviously have that broader volatility, so we'll just have to see. So what happened specifically in the last week or so? The one on everyone's mind and the biggest one here is that escalating war that's happening in Iran and Israel, and what's happening specifically with the oil because of it. Israeli airstrikes hit Iran in early June, causing oil prices to spike 7 to 11%, then cooling slightly. Futures markets dropped sharply on June 13th, with the Dow futures declining 600 points. Investors fear broader U.S. involvement could send oil to $85 to $100 per barrel, swelling inflation and denting growth. Markets have rotated into defense and energy sectors, while treasuries benefited from safe haven flows. This kind of goes along with why I was trying to show you what happens during war times and what has happened in the past. We've seen that pattern that before the war starts or as things are kind of shaky, the market does drop, people are fearful, but then eventually things do get better when there's absolute certainty of some sort. The next biggest thing that happened this last week was that the Fed just kept the rates the same. He also signaled that the September rate cut would be the earliest, but that's not necessarily a shoo-in either. Fed kept rates steady midweek, but Chair Powell flagged inflation risks from tariffs and energy, suggesting rate cuts might be pushed to September instead of sooner. His hawkish calm rattled markets. Equities stayed range-bound, bond yields ticked up, and the US dollar strengthened. We'll see what happens with those Fed rates, but there is a direct correlation to that with the stock market. And with everything else going on around the whole world, it just seems like a lot of craziness all at one time. And number 3 on this list, the thing that kind of shook markets a little bit too, was this dimming corporate and consumer sentiment. Business Roundtable's CEO Outlook Index plunged to 69, which is a 5-year low, as 40% of CEOs expect layoffs, citing trade and housing pressures. U.S. retail sales and housing starts continue to show softness, further clouding growth expectations. Barclays, RBC, and Bank of America warn of heightened macro volatility driven by trade wars, tariffs, and geopolitical risks. The sentiment overall right now is obviously negative, and we just need to keep that in mind. We have some things that we absolutely need to watch out for next week. First would be oil prices. We'll have to see what happens in the Middle East and see if there's any renewed upside. Checking in on the Fed commentary or minutes. The guidance on timing of rate cuts is the most important piece. The tariff developments. especially how US and Canada/Mexico trade relations evolve. And then lastly, like I just talked about, the corporate sentiment indicators or retail housing data for early signs of economic shifts. We know that the sentiment is low, we know that there's a lot of negativity, but we need to see the actual numbers. All of these can move markets big time, and as always, I'll be here to let you guys know exactly what's going on, what I think about it, and what I'm doing about it. Watch either of these videos to keep you going strong in investing, and remember to keep investing simplified.